Welcome to this market and economic update. With the markets at all-time highs, there's a lot for investors to be optimistic about. However, it is equally important to stay focused on long-term investing goals. As President Eisenhower is often quoted as saying, what is important is seldom urgent, and what is urgent is seldom important. I think this applies perfectly to today's market environment. Investors are facing a constant stream of seemingly urgent news, from trade policy to geopolitical tensions and much more. So over the next few minutes, we'll dive deeper into the current market environments and how investors can stay disciplined as the market reaches new records. So it is important to put the current market all-time highs into perspective. Since markets do tend to rise over long periods of time, a bull market will spend much of their time setting new records. So if we look at the numbers from 2013 to 2024, the average year saw 37 new all-time highs for the market, and that would be about 15% of all trading days. And as you'll see here on the chart, last year alone brought in 57 record closing days, despite all of the concerns we had from recession and then the election uncertainty. So new record highs can make some investors nervous. Some may wonder if they should wait for a pullback before investing. While these declines are inevitable, trying to time these can backfire, and so the cost of waiting for the perfect moment to invest is often higher than simply getting started. The rebound in the markets is not just in stocks, but across other asset classes as well. For instance, corporate bonds have also delivered pretty impressive results. This is because credit spreads have been tightening significantly. In simple terms, this means the interest rates on corporate bonds have fallen relative to treasury yields, which pushes bond prices higher. This tightening of credit spreads signals that the flight to safety behavior that we saw earlier has largely subsided. Lower credit spreads benefit the broader economy by making it easier for companies to access capital, fund new projects, and refinance existing debt. For investors, this serves as an important reminder that diversification matters. While the stock market captures headlines, multiple asset classes have certainly contributed to portfolio performance this year. And finally, while strong market performance is certainly encouraging for investors, it's important to remember that building a portfolio goes just beyond chasing returns. Managing risk matters just as much. Recent history provides valuable lessons about how different asset classes perform under these varied conditions. Obviously, portfolios heavily weighted in stocks may shine during market expansions, but they'll also experience larger swings during downturns. Including the right allocation of bonds and other asset classes can help smooth out that ride, potentially helping you stay on track and achieve all of your financial objectives. And while markets have bounced back recently, maintaining disciplined portfolio management is more important than chasing recent performance. History does show that staying invested through complete market cycles remains to be the most effective approach for achieving long-term financial success. We hope you found these insights helpful. If you'd like to discuss the stock market, fixed income, or your portfolio strategy in more detail, please don't hesitate to reach out. We look forward to speaking with you soon.